Hello everyone, it is Sterling here from Trading Forex Live, and I am back for another month-end review of the DTFL bank trading strategy. For those of you unfamiliar with the bank trading strategy, essentially the goal of what we're doing is we are identifying points of liquidity, what we term as manipulation points, and then we are waiting for a stop run of those levels, what we term as a stop run. And that classification of what we term as a stop run is defined into a mechanical rule set. Now that's an important point for what we're going to get into. This month, just to get a little bit of an overview, ended up with about an 8% month. It was either, and this is really the difference, it was either an 8% month or an 11% month. I'll go through why there could be a difference on either of those. I'm gonna go with the lower number just because with these month-end reviews, I always go with the most conservative number because I want them to be beyond reproach. As you know, to me, that's what builds the trust level in these. So we'll walk through that. For those of you that do not understand the strategy and the the entries that we're providing, I will provide a little bit of detail on that. That's not necessarily what these videos are about, but I'll do that just for context because it's important to understand. I'm not just saying there was a trade here or there was a trade there. I'll explain why we know for certain whether there was a trade there or not, why we know for certain whether it was a valid trade or not. For those of you that are members or are viewers of the site, you've seen many of these. Well, it'll be a little bit of review as always, but this month was in the last, this is I believe the 15th month we've been doing this. We started doing these back in May of 2015, and ever since then we've had a during that period of time, every single month we've been doing these videos has been a profitable month. Our worst month was a 0.3% gain, so it was just over break even. That was our worst month. And we average right around about the 10 or 11% mark on average. We have a compounded gain of 335% during that period of time. That's again a compounded gain. In other words, adding to the previous month what you've had or the gains from the previous month onto the next. And again, a compounded gain, 335%. As always, that is all based off 2% risk per trade. So again, 2% risk per trade, not risking a crazy number. That is also based on just trades for the euro dollar and the pound dollar. Most members trade more pairs than the euro dollar or the pound dollar, but that's what these videos are referenced to. So, if you trade 4, 5, 6 pairs, maybe you're not going to have triple the trades if you trade 6 pairs, but would you have double the trades? Probably. Again, that's a variable that I don't try to account for. I'm illustrating what the strategy is capable of with just 2 pairs, and every pair is going to have a slightly different hit rate, different actual reward to risk ratios. So it might not be a perfect conversion to every single pair. I think that's an obvious statement, though. You could say that about every strategy out there, but it gives a very good reference point. So anyways, our first trade, remember we had July 4th, so we had a holiday weekend. We went over the weekend. Actually, the week started on a Friday, which was Friday for July was actually the first, no trade on the first. Then we skipped over to the 4th, which would have been Monday, didn't trade Monday. And then we had one of the longest delays, in part because of a holiday adding to that as well, but just not a lot of trades coming into the first month of July, or in the month of July, and the first trade on the euro and the pound was actually on the 12th of that month. Now, going into that trade was on the euro dollar, and it was a short from 11.11. So here's 11.11 right here. I'm going to bring this level down to 11.11, and I'm going to show you where this level is selected. So I always do this with these videos. This was from the preview, which what we term as the preview, because I select these levels in advance. So daily market preview, July 12th, 2016, and one of our upper points was one spot 11.11, never came into our second upper point. But one of the points that we will look for the stop run to occur, we don't say it's going to occur from that level. We say that this is a high probability manipulation point, and so if it does occur once the market gets to that point, that's when the entry is taken. If not, then no entry. But in this case, the upper point we had contact with, one spot 11.11. So there's one spot 11.11, and the confirmation entry has a very simplistic rule set. Now, this is a very basic overview, so it's not a complete overview of the context or the in-depth overview of the strategy. But the basic premise behind what initiates a trade is really two things for a confirmation entry. Now I'm going to talk about it in the case of a short. It would be opposite if we were talking about a long setup. But the very first thing that needs to happen is we need to have the market break the manipulation point by more than 3 pips. So this 1111 level was broke by about 15 pips. Doesn't matter if it's 3.1, 3 pips, 5.7, 10.9. Again, anywhere from 3 pips and above, that's what initiates a stop run. The second thing that needs to occur is the confirming candle. In the case of a short, the confirming candle has two very simple rules. It needs to, 1, close below the body of the previous candle. And number 2, in the case of a short, it needs to close in the lower 1/3 of that candle. So you measure from absolute high to absolute low and then figure out the lower 1/3 in the case of a short, and it needs to close in that lower 1/3. So those two rules, or all those rules, are mechanical. They can be measured. There is no room for question as to whether it was a valid trade or not. I'm saying that there's no room for question if one person's using one broker and somebody else is using another. That's why we use one standard for these reviews. That way, there's absolutely no cherry picking that could occur on the trades that are fractional or close. Those rules, there is no way to say if the market broke by 2.9 pips and then provided a valid confirmation down, I could not say, oh yes, that's a valid trade, because it didn't break by 3 pips. Therefore, because it's a mechanical rule, everybody would know, no, it's not a valid trade, not a trade that we would take. So again, confirmation candle, 2 rules. In the case of a short, needs to close below the body of the previous candle, and it needs to close in the lower 1/3 of itself. So in this case here's our initiation of the stop run candle. The next candle, it closes in the lower 1/3, more than likely. I'd have to measure it, but it just looks, visually it looks like it's closing in the lower 1/3. But does it close below the body of the previous candle? Well, you can see the answer to that question is no, so that would not, this one right here would not be a valid confirmation. We move on to the next candle right here. It closes, unlike the previous candle, this one does close below the body of the previous candle, but notice how it does not close in the lower 1/3. In fact, it probably closes in the upper 1/3, therefore not a valid confirmation. Now we have a total of a 5 candle count from which the stop run to initiation of the entry can occur, and so it's not a forever moving process, and there's a slightly different way of counting candles, which is also mechanical as well. That's a little more in depth, so I'm not going to cover that. But the point here is that even if you go from the break of the candle, you can see that the confirmation here occurs well within that 5 candle count. This one closes below the body of the previous candle, and it also closes in the lower 1/3, therefore providing the confirming candle, and the entry would be taken on a pullback when we got to within, in this case, 15 pips from the high. This trade runs off and moves down for a full take profit. Take profit was hit over here. We had been moving to break even at the start of the New York session, as per the mechanical trade management rules that we also have in place. It's one of the rules that we have in place, one of the many rules for trade management, that is. And so that would have been moved to break even and got within maybe 4 or 5 pips, and then ran off for a full take profit, starting us off at 4% up on the month. 2% risk for every trade. They're all set with a 2 to 1 reward to risk ratio. Therefore, a full stop out is a 2% loss. A full take profit is a 4% win, as again 2 to 1 reward to risk ratio. We continue over to the next trade on the 21st. And on the 21st, we had a level of 1042. Again, 1042. And the trade that we had, just to go to the daily market preview to show you that, I'll drag this over here. On this day, we actually had a directional bias, so our cycle was to the downside. We were looking for the 3rd push down, and we only had one upper manipulation point, which was one spot 1042. So 1042 was broken here at the start of the day. It's broken at the start of the day. It confirmed up, or excuse me, it broke to the upside, broke by over 3 pips. Next candle didn't confirm, but this candle here, notice that this candle provides the validation of a confirmation candle, provides the confirmation, and the entry is taken on the slight pullback. In this case, the market was taken when it hits the 15 pips from the high, which it does here. And whether it was hit here or here, it was still within the 5 candle count. as this would have been the number one candle based on our candle count methodology. I'm not going to get into why this wouldn't be the number one candle, but there is a mechanical rule behind that as well. It's not a guessing game as to whether you're in a valid candle count or not. The point being is that it pulls back to where the entry would have been and hits the entry point. This runs down and the close would have been right here. Now this just happened to be a nice close on this candle. Fortunately, it didn't pull all the way back and tag us at break even. The reason for this was if we go over to the pound on July 21st, we had a level here of 31.96. Now I'll just drag that over again so you can see pound manipulation points. One of the lower levels that we had in place was one spot 31.96. And so here's 31.96, and we come into that, we create the stop run. When you get an opposing confirmation, in other words, we're short on the euro at this point, if the pound gives an opposing confirmation, or if the euro gives an opposing confirmation, the original trade that you're in is closed immediately. So this right here is the 12 o'clock candle. That's as soon as that closes, that's where the exit would have been on the euro. And if we go back to the euro, you notice that this right here is the 12 o'clock candle. Therefore, at the close of this, open the next candle, it would have been closed out. And that resulted in a 2% profit. It was roughly half of the total take profit. It was a touch over. It was actually closer to 2.5%. Round it down to 2%. That brings us up from 4% on the month up to 6% on the month. We go over to the next trade. The next trade was on the 26th. This was on the pound. This was a long setup. It was a full take profit trade on the 26th. We'll drag over the preview here. And the level that we were trading from was one spot 30.64. That was our one and only lower listed level on the day. Again, one spot 30.64 on July the 26th. And so the market comes down to that level, one spot 30.64. And we see another nice stop run from that point. There's 64. Same process of a confirmation occurs. The market needs to see we need to see a 3-pip break first. We get that here, well over a 3-pip break of the level. The next candle needs to confirm up. It needs to close above the body of the previous candle. Remember, we're going long here, so opposite of the previous setups. And it also needs to close in the upper 1/3. Now this one is a little bit closer. We do have an indicator that's in the members area that automatically plots where a third of the candle is, but just to do it mechanically, you measure from, and again this one right here would have been the confirmation candle after the initial break over here. So here's the low. We measure low to high, and low to high that candle has an entire spread of about 22.6, okay? So just to break out the calculator, 22.6, and we'll divide that by 3 to give us a third. That equals 7.5. We'll round it down to 7.5. Rounding it down gives you an even tighter area it needs to be in. And so it needs to close in the upper 7.5 pips. Does it do that? We'll go right to the high again here. There we go. And drag this down. And right at the close, it's 7 pips away from the high. So another, it closes well within the target area. The point being, or that's the point I should say. So this candle, for most people, confirmed. If this candle didn't confirm, for some people on a different broker, the next candle would have confirmed. Either way, the entry would have been taken on the pullback, and this results in a relatively quick full take profit trade. Runs off, hits a full take profit trade, bringing us up from 10% on the month, or excuse me, bringing us from 6% on the month up 4 more percent to 10% on the month. The next trade that I was talking about that I did not count was on the euro, and I'm going to explain why here. This was not a pre-selected point, so just to drag over what we had on the 26th, on the euro we had a couple points. We had one spot 09.96, and that was listed in red with the asterisk. The reason being is we needed to see more criteria before that level would be satisfied. If you remember, you can go through the video to check that out. But then the next point that we actually had was the one spot 10.44 level. Okay, so as we look at this right here, 09.96 level was blown out well before the start of our trading. So we start at the end of this larger box, which would be 2 a.m. Eastern. And the 09.96 level was blown out well before the start of the session. So that level was really irrelevant. The next level that we had was one spot 10.44, which is all the way up here. Okay, so when we're looking to identify a new level, a very basic rule that we use a certain percentage of the ADR, in other words, a certain percentage of the average daily range, and the market has to move away from whatever point it's turning from, a certain percentage of the ADR. 30% is a rough number that we use as a bare minimum. In this case, this moved down about 25 pips, which at the time was well over, I don't want to say well over, it was probably about 35% of the ADR. Another rule we use is another mechanical rule, is that we need to have at least 20 pips separation in between an existing level, so 1044 was existing, and any newly created point. So this distance was 28 pips. Okay, so the distance between those was enough. It was well over a 30% of the ADR turn from the point it happened to be turning from. Again, we measure wick to wick. And so all the base criteria, again, I'm not getting in, to every rule because the video on selection and manipulation points is an hour long. So I think it goes without saying I can't cover every aspect of it. But those two very basic rules that really eliminate 90% of your levels, those two rules for identification of a manipulation point, potential manipulation point, those two rules were very clearly satisfied. But because it was just over, I don't want to say just over, because it wasn't in a large way over the minimum on the turn back here, I decided to leave that level out. Now that was a 3% trade because you got the break here, you got the stop run, you got the confirmation down. It was a valid from that perspective, and it was a 3% trade. As I explained in the preview that night, for pre-selected levels, right here, there is no discretion. When a level's pre-selected to this point, and all the trades that are counted this month, and probably 90% of our trades come from pre-selected points. When you're talking about those levels, there's zero question as to whether a trade is valid or not. And there's no way I can make it look better or worse than what it actually was, because the rules for the entry are mechanical, and there's hundreds of members watching that, ensuring that every single trade posted is valid. There's no way to make it, again, better or worse. It is what it is because it's a mechanical rule set. When you're talking about a newly created point, there's some, although there are mechanical rules around that as well, there's some room for determining whether a point is valid or not. Now, in the month-end reviews, these represent a very, very small portion of profit. Maybe 10% of our total profit would be newly created points. So it does not make a huge dramatic difference on these month-end reviews, but it does make a small difference. And so in this case, because it was just over minimum by, probably 5%, I opted to leave it out to be as ultra conservative as possible in these reviews. In actuality, if this was a loss, I would have to count it. So I'm almost doing the opposite. If this being a winning trade, I'm not counting it. If this was a loss, I would count it for the integrity of the review. But because it's right on the minimum, I always tend to do this because, again, I want these reviews to be skewed to the downside, if anything. So technically, it should probably be counted, but because it was just over a minimum on one of the criteria, I am going to leave it out. That's why that level's not counted. If you're a member, you want more info on that, feel free to check out the preview from the following day because I give a little bit more of an in-depth explanation on that and cover that as to why. So officially 3 trades. The final trade of the month was on the 29th. It was on the euro. And this was a euro short from 1165. Again, the 29th of the month, 1165. And we have upper level, one spot 1165, upper point, pre-selected point, no question about that. And just like all the other trades, whether it's a winner or a loser, there is no way to make it look anything different than what it is. Start with the basics. Does it break by 3 pips? The high of this candle was 1168 and 1/10, and the level was 1165. Okay, so it breaks by 3.1 pips, which means it's breaking by over 3 pips, and therefore it's valid. If it breaks by 3 pips, it's valid. This happened to break by 3.1. The rule of a confirmation candle in the case of a short is it needs to close below the body of the previous candle. This does that. I'll draw an arrow to that. This candle very clearly does that, and it also needs to close in the lower 1/3 of that candle. Does that candle satisfy both of those rules? As you can see, it very clearly does, I would love to make that not look like a loss, but the fact is, and this is why the reviews can, this is where the integrity of the review comes from, there is no way to make that losing trade look like anything else than what it was, especially when you're dealing with pre-selected points. Remember, all these points in here, not only is it just text that I could go back and edit, I could technically go back and edit that text, but what you also have is you have a time-stamped video in YouTube that cannot be edited. And that's really what ensures integrity of the levels, ensures whether a point was pre-selected or not. And it's also what ensures the integrity of the results in this case. That's a losing trade any way you want to look at it, because the entry criteria is mechanical and it was a pre-selected point. With those 4 trades, excluding the one winning trade that I took out for the reasons I explained a minute ago, that takes us from up 10% on the month to up 8% on the month, and 8% on just these 2 pairs was the total for the month of July. The actual reward to risk ratio, in other words, you can go into a trade with a 10-to-1 reward to risk ratio, but if you end up taking half of your profit, then you actually only ended up with a 5-to-1 actual reward to risk ratio. And so it's really the same with what we're doing here. We might go into a trade with a 2-to-1 reward to risk ratio, but if on all of our losses we only took half of a loss, and on all of our winners we took a full winning position on all our winners, we actually end up with better than what we set out with, and we end up with an actual reward to risk of 3-to-1. Now what happened this month is our only loser was a full loss, and then on our profitable trades, 2 were full take profits, but 1 was a half take profit. Therefore, it drops our actual reward to risk down to 1.66 to 1. So this month had a 75% win-loss ratio, and we had a 1.66 to 1 reward to risk ratio for a total profit of 8% in the month of July on those trades. This illustrates really a couple things. One major thing that I always try to stress where traders get into trouble is they try to take so many trades. They want boom, 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 trade, trade, trade. And while that's fine and dandy once you're a profitable trader, finding good setups, if you find more good setups, that's always a good thing. Where it's not a good thing is when you're a struggling trader, when you're a learning trader and you don't quite know how to trade and you're taking just trade after trade. This month really illustrates the fact that profit is not connected to quantity. In fact, quantity is almost inversely connected to profit for most retail traders. This month really illustrates that quantity, again, especially with the DTFL strategy, has nothing to do with the overall profit. And our goal is quality. If a setup's not a quality, valid setup, then we're not taking the trade, because that's what produces these month-end results. That's why we've been able to produce month after month of profitable, profitable track record. Now with just these videos, over 15 months profitable track record. That's a track record that anybody would be happy with. And that's what also produces our positive win-loss ratio. We average, this month is a little bit higher. We tend to average right around about a 65% win-loss ratio. And we average, that actual reward to risk was about right on par. We tend to average 1.6, 1.7 actual reward to risk. And so when you combine a strategy that has a positive win-loss ratio with a positive reward to risk ratio, you have a very powerful strategy if you can stick to it. Again, it doesn't matter how powerful your strategy is if you don't have the mental discipline, the patience, the mental fortitude to stick to a strategy, to stay disciplined, waiting for the setups, to stay patient, waiting for the setups. Nothing about the strategy matters if the end user doesn't have the ability to do that. And that's what DTFL is designed to do. That's what the daily support of DTFL in the members area is designed to do. It's designed to take traders, work with them, figure out your issues, where are the psychological barriers that you have. Here's some drills to work on to get past certain mental barriers. And so if you're looking to learn how to trade, I'd encourage you to check out the Day Trading Forex Live Bank Trading Strategy. You can go to www.daytradingforexlive.com and have a ton of free information on the front end of the site about the strategy, the methodology, things like that, recent trades. All the past month in review videos are also there under the recent trades section. And you can also learn more about our Forex course, which includes the live room, the members area, lifetime support, as well as those daily market preview videos and the 10-hour bank trading video course that defines the strategy. That will do it for the July month in review. I hope you guys enjoyed the video. And as always, if you have any questions, shoot us an email at support@daytradingforexlive.com or daytradingforexlive@gmail.com. Again, support@daytradingforexlive.com or daytradingforexlive@gmail.com. Either one of those two emails, which you'll see at the end of this video, will get to the same place, and I'd be happy to answer any questions that you might have. That will do it for this one. Until next time, happy trading.